Good morning, I'm Michael Gable. I just want to give you an update on what's happening with the share market here. So obviously in the last several weeks the market has been heading higher, and my opinion is that it is justified and it can continue to head higher from here. So if we just have a look at the daily chart here of the market, we can see the rally off the March low, and then essentially in the last month we have sort of struggled to make much headway. But what we've noticed is that this sideways motion is merely just a consolidation of this prior trend here, and it does look like we're breaking out of that now. So that should lead to a further rally in the market, and I wouldn't be surprised to see our market head towards 6,000. So I think for the moment we've got that upside momentum, and our market should continue to head higher. Now, the reason why I say the rally is justified is because if we think back to what was happening in March, we had a situation where obviously this virus was getting out of control. There was a lot of uncertainty, a lot of fear. We were expecting deaths in Australia in the tens of thousands, and of course stocks got sold off quite heavily. Now, almost to the day when we went into lockdown and we basically had these lockdown measures imposed, the market started to rally. And this is because it's obviously share markets price in what's happening in the future. Where will we be 12 months from now? So the fact that we started to lock down, we started to put this, get the virus under control, meant that we can extrapolate out to where we would be in the future, and that's in a better place than what was being priced in the middle of March. So yes, there are people out of work, and yes, we're borrowing a lot of money, and we're heading into a recession, but that is still a better situation than where we were in mid-March. Not only that, but the flow of news has continued to surprise in a positive way. So, a few weeks ago or several weeks ago, a lot of people were expecting that we'd be in lockdown potentially up until September. And now we're actually starting to get out and about. So things are moving quicker than what was priced in. This is why the market's rallying. Yes, I don't agree that the market deserves to be back at 7,000 anytime soon. That's for sure. But it doesn't deserve to be back in the 4,000s. And I think that if you're waiting on a second dip to retest those March lows, I think you're going to be waiting a very long time, because again, if we think back to what was happening in March, what was getting priced in, I just can't see that happening again. Even if the infection rate does climb over the next few weeks, because we're out and about and moving along, we have to remember that our understanding of what lies ahead of us is a lot better than what it was in March, where it was just pure fear. And I think if you're waiting for all your ducks to line up, then the market's going to be back near its all-time high. So yes, there's a possibility that things could get uglier before they get better. If that's the case, it's quite easy to sell something on the share market. But what if that doesn't happen? What if things do continue to improve better than expected? And I think that's what will lead you to higher levels. And I think if you're still sitting in a lot of cash or defensives at the moment, you're really going to miss out. So over the last several weeks, we've been buying stocks like Aristocrat, Macquarie, Magellan, James Hardie, BHP, Woodside. And if you have a look at what those shares have done, they've done extremely well in the last several weeks in comparison to, relatively safe stocks like Telstra, Woolworths, Coles, even the banks, which I've touched on before as being in a troublesome situation. So cyclical stocks are outperforming for the moment. If we continue to get positive news flow, that will continue to happen. So you really need to think about the mix of stocks that you've got in the portfolio here. There's nothing worse than 12 months from now, the market's trading in the 6,000s. A lot of stocks have rallied, they're not cheap anymore, but the ones that you're holding on to are still at depressed levels. So you've copped it on the way down, and unfortunately you weren't able to participate on the way back up. So it's definitely time to think about the mix of stocks, as I say, if we get trouble ahead, we can always reduce our positions. But at the moment, the momentum is to the upside. Our market's breaking out to head to higher levels, closer to 6,000. And I think that it's very important to have at least one foot in the camp of being invested in the market as opposed to sitting on 100% cash, because I'm pretty confident, I've said this over the last several weeks, that we're not going back to those March lows. There's a lot of cash on the sidelines, and as people start to realise that we're not going all the way back to the March lows, they're going to start buying the dip, and that will just continue to see buying pressure in the share market. So again, don't expect the market to head towards 7,000, but somewhere between here and there, I think is a reasonable level for our market to get to. Okay, well that's my update for this week. I thought it was prudent to send something out, given the way the market's now breaking out, and given the way there's still a lot of I guess bearish people out there that I think are just missing out on great opportunities.